Morning, ladies and gentlemen. Welcome to the Kenya Investment Summit. My name is Ole Machimbirik. I'm Senior Vice President at Verdant Capital, which is a Pan-African investment banking and investment management firm headquartered in Johannesburg, South Africa. And apologies, we short off one speaker, Paul, and got 3 speakers on my right. And, I think I will let our speakers introduce themselves, maybe starting from the far right.
Hello, can you hear me? Good afternoon, I'm Patrick Watson, CFO, good morning, yes. I'm Patrick Watson, CFO of Turaco, which is a microinsurance company in US parent co, operations in Kenya, Uganda, Ghana, Nigeria. I suppose relevance for this conversation, our biggest operations are in Kenya. We raised quite a chunky Series A back in 2022. We've just gone through a process of raising debt as we're moving into the underwriting kind of stage of insurance. And so we've been in the kind of financing space quite heavily over the last couple of years. And we're forming a kind of medium-term financing strategy at the moment, so reaching out to the market for bridge funding, Series B funding, kind of acquisition funding, and so just actually looking at the landscape. And most of that is actually coming from Kenyan investors, so a lot to talk about today on that.
Good morning. Sarah McKenna is my name, from FST Kenya. I am the green finance specialist, the senior green finance specialist at FST. And one of the main things that we like to identify ourselves as at FST is we are a market catalyst. We're not a direct investor, but we want to make the markets work and make sure we have inflows in a number of sectors. But my main interest is green investments. And we are working between the private sector and the government. So we look at how do we influence policy, and how do we then work with the private sector to ensure that there is investments within the green economy. Then we'll be discussing a bit more on what exactly we've been doing. Yes, thank you.
Thanks, Sarah. Good morning, everyone. So my name is Madeline, and I am actually a banker for the last 30 years before I left to co-found Adapter to affect the agricultural sector, because I'm also a farmer and I'm based in Nairobi, Kenya. My other co-founder is based in Washington, DC. So we are building agri-risk scoring methodologies using an algorithm-based tool that looks at optimal crop production metrics and then balances that against the actual farm risk. And then we offer that solution as a platform for farmers to actually score a farm. So traditionally, in my old life for 29 years, we didn't like to lend to the agricultural sector because it's so high cost to serve, and it ends up in non-performing facilities. And a lot of lack of knowledge prevails in the sector. So using climate, water, and soil scores, we look at how do we then offer this as a mathematical number to bankers, language that bankers that I would understand, you know. And then apart from scoring, traditionally the farmer, the banker is also able to score the farm. And then it's specific to crop. So you can have as many as 5 scores per farm, depending on the value chains that are active in that particular location. So it's also location specific. And we also are now placing, we started 4 years ago, and we've placed about $2 million in institutions who are now using the platform, sort of to blend finance. So we put grants in institutions for them to actually match $1 or $2 per our dollar, so that then they are able to lend to farmers using, I think, soft approaches, grace periods, agricultural cycles, matched repayment dates, and also climate adaptation mechanism. So the score also has a report that shows exactly what the farmer ought to do to mitigate their risk against the active climate events in the area. So really pleased to be here. Thank you.
Right, I'm sorry. Great. Thanks, Patrick, Sarah, Madeleine, for the quick intros. So, yeah, as the panel chair, I'll be leading this session, and I think some of the key discussion points that we want to cover in this session are around the status of green finance, climate finance in Kenya. Like, what are the lessons learned? What are examples of the projects completed in that sector? What are the challenges, opportunities? How is the sector performing and contributing towards SDGs? But also also covering the current investment landscape. What is the current status of investors' confidence? I think everyone is curious to know what's happening with Kenya right now and how is the economy recovering from the challenges it has gone through. So, I mean, question to Patrick, maybe to start with, what is the current fundraising landscape like for SMEs, and how are SMEs responding to that?
Yeah, thanks, Olin. Challenging, I think, is the kind of challenging but improving. I think so. What's happening in Kenya over the last kind of 5-6 years, pre-2020, funding was going up quite quickly in Kenya. Valuations were going up quite quickly in Kenya. A lot of SMEs did their raises then. COVID obviously hit. There was a funding drought for a couple of years, well, kind of 18 months. And then 2022, liquidity started to come back into the market. I think a lot of investors were getting FOMO, and valuations started to go up quite significantly at that point in time as well. And then 23, there was another kind of, I don't want to say drought, but there was a kind of a backlash against that as well. Valuations went down. If you look at the amount of money that went into the market last year, very little went into the Kenyan market. It was quite a big drop. That's recovering at the moment. There is more money kind of starting to come back into the market. It's very slow to come back into the market. What that means is funding rounds are taking a lot longer than they were beforehand, so it's not really, it's not unknown for funding rounds to take 12 months plus to get closed, and so that means that businesses have needed to change their behaviour and preempt funding rounds a lot earlier than they would typically do, knowing that it could take 12, 15, 18 months to actually close. Additionally, investors are looking for different things. So, pre-2020 and up to, let's say 2022, they were investing in growth, they're investing in unit economics that weren't necessarily there yet, and an idea of break even and moving to cash flow positive. Now they're very much focused on, you need to be looking for cash flow positive in the next 12 months because we need a resilient business model, because we really don't know where the market's going to be going over the next 12 to 24 months. So again, it's looking at getting positive unit economics, it's looking to flip to EBITDA positive, cash flow positive, proving that your business model works in a sustainable and challenging market, and shoring up your finances. And so it's a completely different landscape. So we are seeing a lot of businesses, specifically in the kind of fintech space, we're seeing a lot of businesses that are running short of cash, and I think that's going to lead to slightly a more acquisitive market over the next 24 months as well, as businesses that were doing quite well 1 year, 2 years ago realize they can't actually get access to financing, and so but have good software, good teams, but they just can't get the money raised. So I think you're going to see a bit more consolidation in some markets in the SME space, and money going towards that.
Yeah, it's good. Thanks, Patrick. And maybe going to Sarah, what is the status of green finance like in Kenya? Or do you have some good examples to share, maybe what FSD Kenya has done in the country and how that is contributing towards sustainable development goals in the country?
Okay. I think the first thing I have to say is you cannot talk investments in Africa without mentioning Kenya, because the level of preparedness first and the level of innovation is top notch. I normally say I cannot sit somewhere and speak about investments without talking about our preparedness in the financial markets, looking at M-Pesa, which is one of the things that we proudly talk about in our ecosystem. So there is quite a lot that's happening in our economy that has allowed us to move to other aspects of investments, like now looking at the green economy, because the reality is we are really one of the worst hit continents by the effects of climate change. So we cannot talk investments without looking at how do we feed our people with a drought that that has now clearly become very cyclical. We know it's coming. We know the floods are going to come for sure. So what do we do about that? What do we do about the food security? What do we do about the healthcare system on green investments? So first, I need to mention that the last time that the National Treasury in Kenya attempted to have a nearly accurate figure on green investments was in 2018. And they have actually admitted that it is currently very difficult for them to have an accurate figure of what is the total amount of green investments that are within the country. Because one, we are not tracking, and we are not able to, we are now in the process of even defining what is a green investment under the taxonomy that is that is currently in draft form under our Central Bank of Kenya. So first is to say that first we've not been tracking it very well, but the figure at around 2018 was about 2.5 billion USD, which was quite good for that time. And I can confidently say I'm sure we've tripled, if not going to 5 times that figure as of now. And the government has really been doing a lot to ensure that we are ready for green investments. And just like everywhere else, then it's innovation that has preceded the policy frameworks. It's now that the government is wondering, now what do we do about a green bond framework to ensure all these people that want to issue a green bond have a framework and have a guideline. The carbon markets, the 2016 Act had to be amended this year to make sure, how do we protect our people? How do we ensure that anyone who's coming in with a carbon markets project then has an understanding that they need to operate within a given framework? So there is bits and pieces of what the national government is doing, what they are requiring our regional governments, what we call the county governments, to do to ensure preparedness for funding, the green finance funding. And to mention specifically for FSD Kenya, we are a catalyst, and we are looking at how do we help the market to bring in innovative financing mechanisms that ensure access to green finance to the end users. Beyond the entrepreneurs, how do we ensure that the financing that is coming in is benefiting the end users? And I can give an example of a project we've done recently with Sun Culture. And Sun Culture is a solar company based in Kenya. And what we did was we went in and did a carbon simulation project with Sun Culture, where we provided money to them and said, we want to see if we put in X amount of money, are you able to reduce your interest rates that you offer to the farmers, so that the end product then becomes cheaper and more accessible. Before we even start supporting them to get carbon markets certifications and they're actually trading, then we needed to see, is this something that they are willing to do, and will it translate to the end user? So that's just one of the projects that we've done directly in green financing, and I'm happy to report that Sun Culture is now currently actively trading in the carbon markets.
Yeah. Thanks, Sarah. Midlina, you mentioned you have experience in climate finance, working with farmers in the agri space. I mean, how do you see that sector performing? What is the current status of that sector? How are farmers performing? How are farmers accessing capital for agri-related activities? Is it an easy process? Do you need more? Is there not enough capital to support them?
Yeah, it's difficult. It's a difficult sector. And as a farmer, I know only too well from both ends of the spectrum, as well as a financier. And it is really the management of that sector that causes the appetite from the lenders to actually really be low. because you look at other real sectors and they have a high risk ROI, and agriculture by nature requires a lot of farm presence. Officers that actually lend farmers may not have the time or the know-how or the backup of resources that they need to actually really manage the sector the way it ought to be. And so that's where technology comes in, and data insights, evaluating from desktop what exactly in that location ought to be happening. And so when the bankers go and visit, then they have sort of like an optimal ideal that they are comparing with the actual activities on the farm. The sector actually causes about almost 20 to 25% non-performing loans. And at any one time, across the industry, and I'm talking specifically about Kenya, from tier 1 banks especially and tier 2 banks, it's only 5% of lending that's going to finance the sector. And yet this is a book that is about, in very early stage, stressed. So we would call it stress management loans, and about 50% of those need constant visits, constant chaperoning, and that then becomes a problem for bankers. So what are farmers doing? They have reverted to SACCOs. So SACCOs are credit unions. Those are more present in the bundus, in the outbacks, in the villages, and these SACCOs are able to really understand the farmers. And so that is one of the ways that at Adapter, we are trying to really capacitize these SACCOs, because remember that the loan officers also need that capacity to know exactly what to do. So I would say that unless there's a deliberate approach to actually build a framework, technical assistance for the lenders, as well as capacity building for the farmers, certify those farmers, and then lend to them. And we have tested that over the last 2.5 years. It works. When you take a control group of farmers in a region that are just having the traditional way of lending extended to them versus a similar group, using a different approach, innovative finance, Sarah talked about that, as well as applying data insights and outputs from a report that says exactly how the farmer ought to adapt to climate change. Then there is a control group comparison that shows that indeed that is a sector that needs a different approach. Now, when you think about, for example, tea farmers, those are about 5 million in Kenya, representing export value of about $1.8 billion annually. And about 25%, not exactly, I know the numbers sometimes are really hard to put together, but about 25% of their productivity per bush, that's going down. So over the last 5 years and over the next, it is said over the next 50 years, tea zones in Kenya are actually going to reduce by a double-digit impact. And you can imagine now the tea authority trying to open new zones for tea and not knowing, will it work? So technology is showing us exactly what kind of climate resilient bushes that need to be applied to these new regions, and exactly what planting structures and management of the crop to really optimize production. Dairy sector is another one. The common breed in Kenya is Holstein and Friesian. And because of heat stress and drought events, the productivity per cow, yield per cow is really going down. That means farmers now are engaging in buying more cows. Now that equals to more emissions. So, and again, I'll talk about Adapter. What we've done with one of the credit unions, the SACCOs, is really to apply what better mechanisms of retrofitting sheds, having enough water for these cows, resting and cow comfort, and as well as feeds that actually have a big and better feed conversion ratio, so that you don't need to increase the number of cows, you optimize yield per cow, and that's actually very possible. Again, we do control testing. There are farms that continue traditional methods and farms that use the different approach using innovation, technology, data insights, and evaluation, and you realize that definitely that's, it's an uptick. So it's a difficult sector, but with I think with the right assistance and framework around technical assistance, capacity building for farmers, innovative finance, and that sort of, climate adaptation approaches, it's a sector that really needs that support and can wake up. After all, it represents almost 60% of employment in most African countries and about 20 to 30% of GDP contribution. Thank you.
Thanks, Madeleine. Maybe just going back to Patrick, with the recent headwinds in the country, I think mostly in the second half of last year and first half of this year, we understand the macroeconomic challenge the country went through, but maybe just understanding how is the country recovering from that and how is the country regaining confidence from investors.
Yeah, thanks, Olin. I think it needs to be put in context. So we're in Kenya, Uganda, Nigeria, and Ghana. And so whilst we talk about headwinds in Kenya, we saw headwinds. We saw much bigger headwinds in Nigeria than we saw in our market in East Africa. So the headwinds that we kind of saw were currency volatility. So the shilling went from 160 odd to 130 in the space of not very long. So that had a massive for a company like us that's consolidating into dollars. That obviously had a big impact on how we look at our results and how that translates. Additional headwinds, there was huge social unrest from the government. So protests, we had to close down our office quite a lot over the first half of this year, and that obviously impacts business, and so that was not positive. I think the kind of message is we need to figure out a way of resolving this rather than necessarily clamping down on the protesters. And then I think the biggest one that actually affected us, and this is specifically to Turaco, because we've been looking for debt for the last kind of 12 months, 6 to 12 months, is the addition to the grey list, the Financial Advisory Task Force grey list for anti-money laundering and terrorist financing. So the other two, currency volatility and protests, I'm not saying they're common in Kenya, but they are part of the macroeconomic landscape. And I think investors invest in Kenya knowing that there is a certain amount of volatility there. But for us, the grey list just chopped off quite significant channels of capital, which has an impact on the amount of money they can get in. And for us, it chopped off because it's coming from institutions, and all of a sudden that they can't actually fund Kenya. And so it affected us, but at the macro level, that's significant amount of money going into institutions from external financiers that cannot actually finance businesses in Kenya because then they are now on that grey list. Now, I know that's not a permanent thing. That's something that can be resolved in the next kind of 12 to 24 months, and my understanding is the Kenyan government is trying to do that. But it's something that's avoidable, that has a big macroeconomic impact. And then, just kind of taking it back to context, the other macroeconomic impact, kind of currency volatility and social unrest, happened in a lot of the surrounding countries. And so relative to those other countries, I don't think it really had that much of an impact on investment going into Kenya. Obviously, it had an impact on cost of living because taxes have been going up and there's been a big impact on that. But the investment landscape, I don't think, was massively dented because of those other headwinds. And so it is recovering at the moment, yeah.
So, okay, that's good. I like Kenya. Kenya is one of our biggest markets. We were invested in Mogo, for example, Mogo Finance. They do asset financing for two-wheeler, three-wheeler motorcycles, borders, and tuk-tuks, and cars for like entrepreneurs and self-employed business owners. And what we saw, following the the headwinds, we saw impact coming from high credit risk from the borrowers because there was high cost of living for the borrowers. Some of them struggling to stick to their debt repayment schedules. Secondly, I think many financial institutions were hit by strong FX losses on their P&L. So you have high impairments in your P&L, and then you have high FX losses in your P&L because the shilling was depreciating against the hard currencies, the US dollars to mention. And so, as an investor, I think some of the things we recommended, to our portfolio companies was, to have an FX hedging mechanism in place so that you can better manage your FX exposure, because you're being funded by, you have a significant amount of foreign currency denominated borrowings on your balance sheet. You need to hedge out the FX risk and make sure that whenever the currency depreciates, you're on a safe side. On the credit side, I think it's just a matter of, on the default risk side, I think it's just a matter of properly managing your portfolio, right? You need to effectively manage the collection process from your borrowers so that, you can control your NPLs. You can keep your NPLs within reasonable limits. But I think, I think things are getting better now. Default risks coming down, FX losses coming down. We have covenants around that to manage it, to see if it's within reasonable limits. But yeah, I think I see positive developments in the country.
Olin, just actually a quick point to kind of add to that. Going back to the kind of cost of living and the headwinds.
Yeah.
We actually did see that play out in a number of our partners as well, because insurance is something that is it's aspirational and it's an additive to a lot of the core products that our partners have. But as the cost of living had an impact in Kenya last year, a lot of partners really kind of retrenched into just focusing on their core products and trying to kind of shore up their businesses. And so we did see that across the SME landscape. Instead of growth in a lot of partners in Nairobi or in Kenya just generally, we saw retrenchment trying to kind of go back to their core and shore up the business and make sure the unit economics are working, and they actually can start kind of moving towards positive profitability.
Okay, great. Oh, thanks, Patrick. Sarah, I mean, so in the green finance space, do you see like other prospects or opportunities that can be explored in the near future that you would like to mention?
Yes, the market, the green finance market, is very nascent in Kenya. I know there are people who are looking at it and thinking there's quite a lot that has been happening, but when you look at the level of investment and what's happening within the national level and the county governments, then there's opportunity for us to invest within both nationally, and we've only issued one green bond, which we've been talking about since it was issued many years ago, that sometimes it's become, you don't even want to talk about it because everyone says, oh, okay, it's Econ, that was students, accommodation, then what next? The truth is, even county governments now are trying to issue green bonds. And that shows me that there's an understanding that keeps on growing in terms of there's an opportunity here. There is something that we can do with crowding in green financing for the government projects and also for the private sector. So first, I'll need to talk about the opportunities first within the government. We are currently supporting a huge project in 10 counties where we are calling it the Green Finance Preparation Facility. If you visit our website, you'll see quite some documents that we did an assessment. And I need to mention, we began this work by calling it a Green Bonds Initiative. So very ambitious. We thought that we will be issuing 10 green bonds for the 10 counties. But in 6 months in that work, we very quickly realized that there was no appetite. First of all, the macros were not working for us. The debt levels in the country, so National Treasury was not willing to guarantee the counties. The lack of even understanding of what is a green bond in the first place. So you go in and then county governments are very enthusiastic and they think you're bringing in more grant financing. And 3 sessions in, they're like, no. We are not about to get money that we will pay for. But when you look at the projects that you had already done an assessment on, you don't want to give up on those projects, because if it's what we call the water associations, every county has one, there's a lot of potential for us to go in with a green economy mind. So you don't want to, just because there is that lack of understanding, then to say we will not be going into finance and to offer support in it. So we then had to quickly reorganize, and we are now working on it as green finance. So looking at different instruments that we can work and support the counties to raise for the different projects. And every county, if you look at the documents, every county has nothing less than 20 projects that have been long listed on the potential. And these are projects that we already did an assessment on, and we can see a potential. Some commercially viable, others not commercially viable. And when we look at those projects, we know that even those that are not commercially viable will have an impact. And so we are looking at how do we design them to be able to support the county governments to raise the financing for them. So we're in a 1-year journey, we're only 3 months in, to support the counties, to design these projects, to develop the investment memos, to come in and develop the investment proposals that then work both for the commercially viable, because we are looking at how then does this green financing also become a revenue source. Because one of the other things that we know green financing has been associated with is risk. And she was speaking about it, Madeline was speaking about it. The financial institutions don't want to touch anything that looks like the risk is very high. So sorry. So when we talk about financing for solar, they don't understand it. When we talk about an EV company going to get financing from a bank, we're using the same credit officers. So for them, it's very high risk, so they don't want to do it. So beyond all this, working with the counties, within the private sector, it's also building the capacity, because there is potential for financing. And I need to mention, we have the bigger commercial banks that have also really begun by launching bigger projects on green financing. Equity Bank, KCB have been leading on that. And they have partnered, I think Equity Bank has a partnership, is it AFDB? Okay, let me be careful not to lie, which partner. So so they have a big partnership, and they're trying to see how do we intentionally lend for green finance and green products. And here we're talking about value addition in agriculture, where we need to, Madeline mentioned a very important thing. You cannot lend as usual. This is someone you lend to, and you have to behave differently. You both have to be on the same page to know that we need to provide more support to them to ensure that we are getting markets. So it's a value chain financing model. It's not you throwing money at the problem and thinking that there will be a solution. So there is quite some massive opportunity in the green finance landscape in Kenya. But then within the financial institutions, we have to behave differently. We cannot think we will lend using the same models that have been used within the financial institutions and get different results. Because already there is risk. Every time you mention the green economy, risk is at the top of everybody's mind. Yeah.
Thanks, Sarah. I mean, I like it when we talk about EV financing or green or climate-related issues. I mean, I'll give an example where we're supporting institutions like Mogo, Water Credit. They do asset financing for two-wheelers, and they have started financing for EVs, and we're seeing great developments there. We're supporting them as as an investor. In those companies. It's just a matter of Africa's behind when talking about EV financing. I'll give an example. Like in Zim, I don't think we have a single electric vehicle in the country. It's all like fuel powered. It's all I see. People need to learn the concept. They need to understand the cost saving behind that. Understand the cost of buying an EV is higher than the cost of buying an ICE bike, but the cost of running it is way lower than the cost of running a fuel-powered bike. So those are some of the things we're doing with institutions like Watu, Mogo, try to drive and finance and make sure that the EV space gets the financing it needs to grow.
Sorry, I thought maybe let me mention the carbon markets. I think we can't talk about opportunity without remembering that there is a huge opportunity within the carbon markets. And now we have a regulation, so there is no fear that there's no framework to operate around when you're trying to get into the carbon markets, both for the nature-based solutions and any other solutions that could then trade within the carbon market. So I think there is quite a huge opportunity to crowd in funding for green investments through the carbon markets. Yeah.
Good. All right. Thanks, Sarah. Madeline, I don't know. Maybe in the country, I think you've gone through like drought conditions and recently the floods in the country. How did the government respond to that? Any initiatives implemented to support the agri space?
Okay, and when I think of flooding, the Tana River Basin is actually really prone to flooding. It's a large river that cuts across the dry lands in Kenya. And there's what the government did, and there's what I think is the right response, yeah? So no more evacuation, so life first, human life first, and then trying to resettle the people, and then trying to really bring up their livelihoods by seeing how do they get small support to actually settle down. But I look at that and I think the way the Tana River, using our algorithm tool, is really great. The soils there, actually the silt that comes with flooding, really great for example, rice. And I was talking to a partner I won't mention, and I was saying, rather than just grab life, relocate people, that's important, but how about turning that around to actual active economic benefit? And we were looking at having small farms. This is still in concept. Small 1-acre farms, because the tool has difference between 2.5 kilometer radius from farm to farm. So you can actually know exactly what even dryland crop to grow, because it is possible that in the flooding, rice can grow, and after the flooding, other dryland crops actually grow very well. So I think there's a need for coordinated effort between public sector and private sector, because there are people with knowledge. And I like what Sarah said, you don't throw money at the problem. Just say, these people just need their children to go back to school, and here is some fees and some food for money for food. I think we need to think deeper about what else can be done sustainably. And on one hand, I see a lot of data exists. There are research bodies that have a lot of data and equipped with the knowledge that can be applied. And on the other hand is the capital. Now, for example, the banking industry controls about worldwide $150 trillion in capital. And agriculture itself just needs $1 trillion annually globally to actually drive adaptation, do things differently. And so when you drill down that to a local level, I think the people with the data and the knowledge and the people with the capital and the, and the finance ought to be talking together. And that's what we are attempting to do at Adapter. Bringing together who has the money, who has the data. And, when you think about the national, the designed goals for climate, there's a Kenya National Adaptation Plan that talks about mitigate, climate risks and as well as adapt to the climate events. And 32% reduction in emissions is what the country has committed to do. And also, proper land use, talking about what we were just saying, the example of flooding, do we have 73% of the region actually dry and vacant? Yes. But is it possible to turn that vacant rangeland into actual production, crop production? We've done that in a very dry area in the north of Kenya, near Lake Turkana. Farmers in 45 villages growing melons, lemongrass, onions, as well as grapes, and actually aggregating and putting that produce in the market. Before that, that was a pastoralist area, not even agro-pastoralism. It's just farmers totally communities totally nomadic, moving from place to place, cows dying because of lack of feeds and the drought events. And really, I'm not discrediting the government, but what I feel is that there needs to be a coming together of who knows what to do in such a case, plus who has the money to actually effect it, plus the government now really creating the enabler, the enablement that needs to bring that together. And talking about the villages, I was saying, it's really exciting now to see fat babies, babies who are starving, I visit there and they are healthy. They are growing produce, of course, then there's subsistence farming going on. Why? Because when we looked at the capability of water in that place, the water tables are really very near. So shallow dams and, and wells and that sort of having knowledge passed that you can actually grow crops. The soil is great for some crops and not others. Of course, you can't grow tea, for example, in that region. But there is capacity to actually, and I'm not a scientist, so we used an institution called CGIR. It's a global institution of a conglomerate of about 15 different institutions. Some, the Maize Institute, the Potato Institute, I think those who are familiar with it, the Water Resource, the Water Institute. So they bring together data, and we are able to see what is possible in 73% of dry lands in Kenya that can become agricultural, and of course the government plays a big part in also identifying key value chains of interest per county, in all the 40-something counties.
Yeah.
And also, I think, bringing together the effect of capacitizing those farmers by, the knowledge that we are talking about.
Yeah. Okay. Thanks very much. I think fruitful conversations here. Thanks, Patrick, Sarah, and Madeleine. Maybe I think we can open the floor for questions.
Charlie Robinson, I work at Fund Magical Film Partners. I'm just curious whether you feel the tone has changed about paying debt since the protests. That pre the protests, the assumption was Kenya always pays its debts, but maybe post the protests, it's we're not prepared to hide taxes and see them stolen, and we'll just default because Ghana did, and they sorted out in 2 years. It's been taking 4 years. It's taken Zambia. So do you think there's been a shift in sentiment? Actually, maybe default's not the worst option. I'm just wondering what your sense is, being on the ground, whether people have changed the tone of thinking or not.
Okay, I think I can give from my old life. There's been protests, in 2007, and every time, when there are elections, actually debt suffers. There's strained, capital gets strained, and repayment becomes something that's, out there, and I'm talking about even individual borrowers. But Kenya as a sovereign, I think I'll let somebody else answer that.
This is not a perfect answer at all, but we've been looking at hedging across our 4 countries. You obviously can't really hedge in Nigeria and Ghana because it's just ludicrously expensive, and that's to do with default volatility. Then you look at Uganda hedging significantly cheaper than Kenya. Kenya hedging has gone up a lot recently because of the risk inherent in the country. But my point being, there is a real cost to default, and it does have an impact on a macroeconomic basis, and I wouldn't say that Ghana's recovered from that at all. The cost of financing in Ghana and the money going to Ghana has gone down massively, and it's extremely expensive, and that affects the cost of debt for all SMEs in that country. I don't know what the government's thinking, but it would have a real material impact if cost of financing started to go up significantly in Kenya, and I think the government, I would hope a logical government would be averse to going down that road.
Of course, this all remain personal opinions. I think the efforts that are being made is because the government does not want to default. I know as Kenyans we're feeling the pinch because they're trying to tax everything and anything, but the attitude that is there, looking at it logically, is not default. Because they know, like Patrick has said, they know the cost of default. So there's effort, and I think we can only wait and see, because if you look at what the National Treasury, what the Central Bank has been talking about, the efforts that they've been making, everything speaks to that is the last option that the sovereign is willing to take. So we may not understand it, and I'll say this, if we cannot take the protest as is, because sometimes it's very hard for you to explain the macros when people feel they have less money in their pockets. It's very hard for you to go and start explaining, we are taxing you because we borrowed a lot of money, now we need to pay. Because what that means, you're reducing disposable income. And I think a logical economist would just ask you, but we have not seen an economy grow by overtaxation, because what economics says is reduce disposable income, spending reduces, and the cycle continues and we shrink the economy. But in the short term, where I sit, this is the solution for the government. And that is what I see when I'm not thinking about the reduced money in my pocket, is that I know they don't have an option, that they will tax. I don't even think we are done yet. Sorry to the Kenyans in the room. I don't think we are done yet. I am waiting for, they are sitting down and thinking about another creative tax. We will go to the streets and we will still be taxed. It's the price we will have to pay where I sit, yeah.
I was curious not about the logic, but about whether the tone of conversation with friends, with people on WhatsApp groups, have changed.
I think that you will have to look for us.
Okay. Yeah, I think the sentiment, there's anger, you know. It's just rattling but I think I like what Sarah is saying. So there's what's happening. I like the analogy of WhatsApp groups. That's where the real stuff, you know, that's where people really open up. But there's commitment. We work very closely with the PPP Directorate, and you can see there's been a change over years, so that interestingly, they're actually bankers that are in government now, you know, and really are looking at things from a fiscal lens, yeah? So the commitment is there. I mean, I think about Zimbabwe. What would happen to Kenya if we become a defaulter? I think there's too much at stake. There's too much at stake for the professionals that are behind. So when you look at, you know, the presidency, when you look at that, you might feel discouraged, but behind those men are real professionals who sit down and want to build what will hold Kenya as a sovereign together.
Sorry, can I just add one? I think it's a really interesting question, because the tone definitely did change earlier in the year. I mean, people got really, really angry, and there was concern that this was going to carry on going. But the protests did die down, and the chattering has died down, and no one knows if it's going to flare up again. You know, something could trigger it. A government policy could trigger it again, and then it could come up again, and people remember how angry they were again, and it could start becoming more of a continuous cycle. But, I mean, the only evidence you have at the moment is businesses are not shutting down. Protests seem to have died down. Things have calmed. People forget quite quickly what happened in previous years. So, I mean, none of us have a crystal ball. I mean, the naive side of me hopes that this means that the government realizes people want them to be accountable, and then they stop, you know, not being accountable. But we'll see what direction the Kenyan government kind of goes in.
All good, great answers. Thank you.
All right. Any more questions? No further questions. Oh, okay. Rishwa, Patrick, Sarah, Madeleine, do you have anything to say in conclusion? Or?
I think only thing I would say, this kind of concluding comment about, you know, it's the Kenya Investment Summit. I think whilst, and Sarah, you and I were talking about this quite a bit beforehand, whilst Kenya's not, you know, it's not like the perfect destination for investment on a lot of metrics. It sits in a neighborhood whereby the government is getting in your way less than in a bunch of other countries. There is significantly more stability than a number of other countries in the neighborhood. At least in the insurance space, a lot of the government affiliated regulatory entities are more facilitating business than getting in the way, impeding business. And at the end of the day, there's a much bigger ecosystem. If you want to launch a tech-enabled business in Kenya, you have a tech-savvy population, you have a kind of much more established digital finance space, you have quite a significant population with money in their wallets, so there is wallet space there as well. which you don't get in a number of other countries. And so it still remains a very good launch pad to invest and to launch businesses that are regional businesses. If you were to do that in Uganda or Tanzania, we just created a business in Tanzania. Creating a legal entity and an insurance business in Tanzania was infinitely more difficult than it was in Kenya. And then getting our underwriting license, infinitely easier than it is in so many other countries because the regulatory environment allowed us to do that. And I would hope the government's behind that.
Okay, I think for my concluding remarks, the first thing I'll say is referring to the FinAccess, that's a report that we develop every 4 years under FSD Kenya. The last report indicated that financial inclusion was at over 90%, and I believe the report we'll have this year will have quite a bigger number. That's good enough. And what that means is what we were using was access to M-Pesa, etc. And it allows you to be able to assess the credit worthiness, credit risk assessment. If there is a country that has been used for AI credit risk assessment in every shape, size, and every form is Kenya. So we have the right environment for investments in different sectors, in different regions. There's preparedness for investments. And what we need to do, and what I believe we need to also be doing, is looking back and monitoring the impact, the real impact of the investments that have been done, especially in green. Because these are investments that directly touch on livelihoods. These are investments that are directly touching on healthcare, access to even education. They are directly touching on food security. So we need to have a discussion and look at, okay, this is what has been done within the smart agriculture. This is what we've been doing for clean cooking. What is the impact, the actual impact that we have seen over the years? And this then informs where the direction that we need to go. And for any investor that wants to come into Kenya, you need to also look at what are the government priorities, both at the national and the county levels. This allows you to be able to understand what is then the general direction that even policy is likely to move towards, and how easy will it be for you to conduct business. Otherwise, Kenya is a great place for you to invest. Thank you.
Thanks,
The bell has rung, but I'll just quickly say, for a sector that's so important, I speak for agriculture, I think a challenger model needs to be in place actively so that the conventional banks and what they are doing is challenged by what credit unions can also do if they get support. And by support, I mean put in some funds so that they actually have a guarantee or a first loss bucket, so that it appetizes them to know, after all, we are having approaches that have a fallback. Because I think really the credit unions, the SACCOs, kind of don't get the attention that they require, yet they represent so many millions of smallholder farmers' interests, and they are actually able to tackle that sector. And these are farmers who actually belong to cooperatives, so there's an offtake, so market is not necessarily a problem. So I think there needs to be that switch, and that's what I am geared. That's my mission, actually. When I left the industry, I said, you know what, I'm going to concentrate on who I think can actually bring the change that's required to drive and unlock capital for adaptation into agriculture.
Okay, great. Thanks very much, Patrick, Sarah, and Madeleine. I mean, from the Vedan side, we like Kenya. Kenya is one of our biggest markets. I mean, we've done a lot of deals in the microfinance space, and we see a lot of opportunities in that sector as we, as a social impact investor, trying to address the the SME credit gap that still exists in the microfinance space. We aim to make sure that we support microfinance institutions doing predominantly SME lending, creating jobs, income generation, improved livelihoods, and contribution towards the country's economic growth. I think Kenya is still is still looking good for us. We're starting to see, credit default risk coming down on the new vintages compared to the vintages from last year. As a result of the macroeconomic challenges. I think, we'll look forward to, completing additional investments in the country. All right, thanks everyone, and enjoy your day.